Welcome to a video that I like to call the deep dive video. Please don't let this name mislead you. I post a number of videos each week. I post them every day. I have a weekly video. I have an intermarket analysis video. When I get done doing all of those posts, I go back and I look at all the daily charts and I pick out the charts that maybe I didn't talk about at all, or at least very much over the last week. This video is supposed to show those charts that maybe we can still get some insight from, even though we didn't use them in our daily analysis. Now, this video is going to be a little bit longer because there's an extra section that I'll have to go through right at the beginning. This includes the current market valuation. I usually like to include this in the weekly video, but by the time I got ready to record, they hadn't updated things on their website. So let's look at the valuation overall. They're currently saying that we're overvalued, and right now we're just a little bit above the 1 standard deviation. If we were to come back down more to this black line, we would be more fairly valued. Then we look at some market valuation models. We're considered to be overvalued when we look at a thing called the Buffett indicator, which compares stocks to GDP. We're breaking above this 1 standard deviation, and when we go above this yellow line, we're considered overvalued. Also, the price earnings model, we're above the 1 standard deviation, so that's overvalued. When we look at the interest rate model, because historically interest rates are still pretty low overall, we're not up to the 1 standard deviation yet, but we're still positive, but yet we're considered fairly valued. The mean reversion, how far are we away from the historic trend line of the S&P 500? The historic trend line tends to act like a magnet or a rubber band where price will come back to it. Well, we've been able to go quite a ways from that, and we're into overvalued territory. Then we look at recession indicator models, the yield curve, because we have so many yield curves that are inverted. This is very high and suggesting that we may head into a recession. When we look at the state coincidence model, these readings are still pretty low. The higher this goes, that means the more states are having trouble. And as we go up, that means that we may likely go into a recession. But right now, this is pretty much normal. We look at market sentiment models, where there's not a lot of margin being used in the market. Now, this was updated at the end of May, so it's a little bit out of date. When folks use borrowed money to get into the stock market, that means that they're quite optimistic about the future of the stock market since they have to pay all that money back. The junk bond spread is still neutral. We're above the historic trend line, and we've not been able to get up to the 1 standard deviation. Now we go into the different charts that I didn't really cover. The first chart is the VIX to the 3-month average of the VIX, and then we take a ratio of that. That's the black line. And then what I follow the most is the red line, which is a moving average that I place on top of this. As this is going down, that just suggests there's not a lot of fear in the market. Also, we have an RSI 9 period that I plot on the VIX. We're not giving an extreme positive or negative reading right now. Then we look at the ratio between the VIX and the VIX of the VIX, and then take a 50-period moving average. And really, since we hit the low back in 2022 or thereabouts, this line has been coming down, and that tends to be more positive for the market. We also look at the range for the VIX. I did show this recently, but we're seeing the VIX really dropping when we see the 50-period moving average of the VIX over time. Typically, with the VIX, you use static numbers. It's 12.5 to the downside, 20 to the upside. Well, the VIX is also its own thing, and it goes back and forth within ranges, and this helps us to determine what kind of a range we're in, and we're actually dropping down below 20 on a historical basis. Then we look at the equity put call ratio. This is a daily chart. Even though we had a down day on Friday, the equity put call ratio did decline. Then we look at a 5-period moving average of the equity put call ratio, and then I have a longer term version of this chart that I actually show pretty much every day in the daily videos. How far are we from the all-time high? We're down 8.71%. We hit the high in early January 2022, and over on the right-hand side is where we're at currently. Then we spent a lot of time going above and below 4,000. I just kind of put that in there to see how many times we've chopped above and below that level. Technical alerts are put out by stockcharts.com. These are generated. You don't have to be a member to have access to this. When they're red, it's negative. When they're blue, it's positive. And we read these from the bottom up, where right after the open on Friday, the materials sector ETF had a bearish MACD crossover. Then we had a few positive things happen, especially in the NASDAQ. It went above 13.7 and then 13.8. The Dow was able to get back above 34,000. And then near the end of the day was when we saw some weakness and the S&P crossed below 4,400. What we look at are 5 indexes: the Dow, the NASDAQ 100, the S&P, the mid caps, and the small caps. And StockCharts.com has a tool that objectively rates these on a technical analysis score. 0 being the lowest, 100 being the highest. The closer we get to 100, the better technically looking that chart is. Coming in first place this week continues to be the QQQs, which is based on the NASDAQ 100 at 98.2. In second place is the S&P 500 at 87.8. In third place are the mid caps at 82. In fourth place are the small caps at 56. And coming in last place is the Dow at 41.8. Then I have a few short-term charts to show you. This is the short-term rainbow. I had been showing this as we were coming down to the 10-period moving average. So far, we've been staying right at about that level. Then another short-term chart. Now, this can switch different categories, but the one that I'm focusing on is a thing called the boom indicator based on 20 periods. How far away do we get from the moving average? As I said at the beginning of the video, a moving average or an average price will tend to act like a magnet or a rubber band. If price gets too far away from that, it'll have a tendency to come back. And that's what this indicator tries to measure. When we get up into an extreme positive reading, that means we've gone up a little too far too fast. We measure this based on 20 periods, 50 periods, and 200 periods. Usually the 50 and 200 will see the general trend of the overall indicator. When this really comes to the forefront is when we go extreme positive in the short term. And we did not so long ago, but now we've been coming back down. Fundamentals, just to keep an eye open for where we stand based on the earnings. They are pretty much flat for the S&P. The PE ratio ticked down just a little bit this past week, even though it's been going up overall. As price goes up and the earnings aren't there to justify it, it makes the PE ratio go higher. And inverse of that is with the yield. As price goes up and the dividends that are paid, this has a tendency to go down. Intermediate term charts. Here's the CMB composite. I did bring this up when we had an extreme positive reading, but now we've been dropping back down. Then we have the highest high and lowest low values. When we're really going up and we're at the highest high value, that just shows a good strong trend. When we're going down and we're hugging the lowest low value, that means that we're really moving downward. And then I have a midpoint on here just to give us some kind of an orientation of where we're at. We're still above the midpoint, so we're positive, and the line is starting to go sideways as the market has been slowing down a little bit this past week. We look at the Connors RSI, which we read just like a regular RSI. We look for extreme positive and negative readings. When we're below the dashed line and declining, that's more negative. Above the dashed line and advancing, that's more positive. Then we look at the 50-period moving average, and this is a simple moving average and an exponential moving average. We're well above both of them right now, so I haven't been including this chart. The same thing is true with the 100-period simple and exponential moving averages. Then we have an intermediate term rainbow going from 50 periods up to 100 periods. We're well above all of the lines in the rainbow, and the rainbow is starting to flatten out. This is what we look at when we're really moving in one way or the other. When we come back down, one of these levels may provide some kind of support. We also keep an eye on the 50-day cycle. This seems to have been effective over the last year or so. The last time we hit a 50-day cycle was on May 19th. The next one will be on August 1st. Now, looking at this chart, sometimes it's marked a bottom, sometimes it's marked a top, sometimes price just keeps going in the same direction that it was already going in before. Then we look at standard deviation. Are we above or below what could be considered to be the average price over 10 periods? When we're below this moving average, we're below the standard deviation. When we're above it, that means price is really moving, and we've been below it now for quite a while. For a long time, I was showing this chart in the daily videos, but now we've dropped below this red line, so the Pring bottom fisher is not generating a signal. Then we have an anchored moving average going back to the all-time high, and we're well above that, so I haven't been showing this chart. How far are we above or below the 200-day simple moving average? Currently, we're still above that. The mass index is not generating a signal right now. We only pay attention to this when we get to the red dashed line and the blue line. The ease of movement. This tells two things. On top, we have green bars, and the thicker the bars are, the more volume it is. When they're red, that means it's negative. And then on the bottom, we have the ease of movement indicator, which tries to measure the path of least resistance, either up, down, or sideways. For a lot of May into June, the path of least resistance was up. Now we're seeing that starting to come down, but we're still above the dashed line. This is a chart that I was showing back in May that possibly could have generated some overhead resistance. What this is, I got this idea from Game of Trades, where they had the two lows set back in 2022 and drew a trend line. And then there's a parallel line going to the all-time high. And as price was going up, this area could have acted as overhead resistance. And it did. We came up to this area, bounced back, came up, bounced back. Well, now we've been able to break through it, and we're far away from this trend line, so I haven't been including the chart. Then we have the Ichimoku cloud, which can act as support or resistance. When we're above it and coming down, it's support. When we're below it and coming up, it's resistance. Right now, we're still far away from the cloud. Then we look at the Bollinger Bands. We're just above the midpoint, so we are positive, and we're not at the upper or lower Bollinger Band currently. That's what this next chart measures, is the percent B indicator. When we start to exceed a band either upper or lower, then that gives us an extreme positive or negative reading. The Kopit curve was also generating a signal for a while. This is a momentum oscillator, and it was giving us a good signal for a while. Now it's dropped below the red line and is declining, so that signal is no longer there. Also, the point and figure chart, there's been no updates. The last signal that we had generated on this chart was on May 18th, where we had a double top breakout. And there's been no new X's or O's drawn into the most recent chart. Some long-term charts. Here's a longer-term rainbow going from 50 periods up to 250 periods. We're above all the moving averages, and the lines are starting to smooth out. Then this is a chart that we often use as part of our possible positive scenarios. The idea behind this is when the 2-year yield spikes and then starts coming down, that can often give short to intermediate term support to the S&P. The only problem is the 2-year yield and the S&P have had a real strong correlated relationship of going in the same direction at the same time, so this really hasn't been all that helpful for us. Now that could change at any time, but up to this point it hasn't been really insightful. Some support and resistance, I haven't been showing these because we're far away from either support or resistance lines. This is a quadrant study, which just measures from the COVID low to the all-time high and breaks them up into 25% chunks. And this had acted as overhead resistance. Well, we were able to break through that, and now we're waiting to see, are we going to come back down or are we going to go all the way up to the 100%? But we're kind of in no man's land right now. With some of our other Fibonacci charts, we're also in no man's land as we're above this 100% retracement level. Our longer-term Fib chart is also above the 61.8% retracement level, and our long-term Fib chart is also above these other Fib levels. The next possible level up would be going back to the all-time high if we go higher, or coming down to this 42.14 level if we start to fall. Some broad market measures. This is the Vixen, which is the VIX for the NASDAQ 100, showing that fear is really decreasing overall, even though it has ticked up over the last few days. We compare the S&P 100 to the S&P 500. There was a period of time in April and May where the S&P 100 was starting to go up as the S&P 500 was going sideways. They're moving more in tandem with each other right now. We keep an eye on the microcap index, especially when it gets down to this 100 level. It did set a new 52-week low when it dropped below 100. Right now we're at 106.65, so I haven't been including this chart. We keep an eye on the Qs. This is a weekly chart with an anchored moving average going back to the all-time high, and we're far away from that, so I haven't been including it. Then we keep an eye on the financial sector, where back in 2007 we had a high, then we retracted down from that. We came back up, which this now acted as resistance, and then we were able to break through that. What once was resistance, if we go above it, now becomes support, and we're still above this level as far as price is concerned. If we start to drop back down, we'll be watching this chart closely. Then we keep an eye on a weekly chart of the S&P 500 because there's a strong correlated relationship between the weekly chart of the German DAX, the biggest stock market in the EU. We can see down below where they do have a pretty strong relationship, even though it's been going down a little bit lately. Some rate of change charts going back 250 periods. We've been coming down just a little bit with this chart. This next chart is the same chart. It just goes back longer to show that we have been showing some recovery, but some recent weakness. Looking at bonds, this is the 2-year yield in green and the euro dollar, which are dollars outside of the US, in red, which is a good proxy for the Fed funds rate. We also keep an eye on the yield curve, and all the ones that we follow continue to be inverted. We also look at the 1-month yield and then subtract the 3-month yield. The red line should be on top because it's longer term, so you should get a higher yield. But there was a period of time when we were dealing with a debt ceiling issue where these were starting to invert. Now they're going back to normal. We also are keeping an eye on the S&P 500 and the long-term bond ETF. They tend to have a long-term relationship of going in the same direction. We've seen that really weaken now, which is suggesting a lot of uncertainty longer term. We're seeing a little bit of improvement in the shorter-term relationship, but it's still showing that they're having a tendency to go in opposite directions, and the spread between the two is still pretty wide. Then we're looking at the 10-year yield in the U.S., and we subtract the German 10-year yield. That gives us a line right here with some support drawn in here, and we compare that to the U.S. dollar index and see that there's a pretty strong correlation between the two, even though it's been going down a little bit lately. Our possible positive scenarios, these are some charts that I did show off and on during the last week. These are the stocks above their 50-period moving average. When we're above 50 and advancing, that's positive. When we're below 50 and declining, that's negative. We tend to use this like an oscillator when we get an extreme positive or negative reading. We also keep an eye on the mid caps, which continue to be positive, and the small caps, which are also positive. Then we look at the percent of stocks in the S&P above their 200-day moving average. It's still above 50. We can also use this like an oscillator. So we just look at the dividing line to tell us whether it's positive or negative. So thank you. I hope you found this helpful. Please feel free to check out some of the other videos that I post. Have a really good weekend, and I will talk to you in the next video.